Welcome students. Myself Dr. Danish Kumar TK, Assistant Professor, Department of Economics, Dhyan Prasarak Mandals College and Research Center. Now we'll be discussing your Public Finance 1 paper, Unit 4, Budgetary Process, module name, Budgetary Reforms, especially Tax Reforms and FRBM Act. I'll be covering the tax reforms in India, the recent the development, and FRBM Act. At the end of this session, you will be able to evaluate the tax reforms in India and identify the need for FRBM Act. Prior to the liberalization of Indian economy, if you look at our tax regime, which was suffered numerous problems. If you look at the direct taxes, there was high degree of progressiveness, large number of exemptions, and there were numerous discrimination, and the poor enforcement of direct taxes led to tax evasion and adverse effect on tax collection efficiency. If you look at the indirect tax system, the high rate of customs excise duties were prevalent. There was no VAT, there was no service sector within the purview of taxes. So there are a number of issues we were facing during 90s. Now the government appointed a tax reform committee under Professor Raja Chellayya to lay out agenda for reforming India's tax system. This tax reform committee came up with 3 reports in 91, 92 and 1993 with several measures. Further, the government appointed the Vijay Kelkar committee in 2002 to provide direction to the tax reforms in the country. All this results in a lot of changes in Indian tax system, especially reduction in the corporate tax rates, bringing the service sector in the tax net within a VAT system, broadening the tax base, building a tax information and computerization, improving the quality of tax administration. Now we look into the major reforms which took place in India recently. The first is the Goods and Service Tax, GST, is so far the biggest reforms in the country. It is an indirect tax which replaces other indirect taxes such as VAT service tax, purchase tax, excise duty, and so on. GST levied on the supply of certain goods and services in India. India has adopted dual GST, especially central GST, that is CGST, and state GST, SGST. Central GST is collected by the central government and the state GST collected by the state government. And we have the integrated GST is levied, especially the interstate transaction. It is levied and collected by the central government. Now, another important reforms which took place for corporate tax system. In order to promote growth and investment, the government has brought in a historic tax reforms through the Taxation Laws Amendment Ordinance 2019, which provided a concessional tax regime of 22% for all existing domestic companies from financial year 2019-20 if they do not avail any specified exemption or incentives. Further, personal income tax, if you look at, in order to reform personal income tax, the Finance Act 2020 has provided an option to individuals and cooperatives for paying income tax at concessional rate if they do not avail of specified exemption and incentives. Next is pre-filling of income tax return. In order to make tax compliance more convenient, pre-filled income tax returns, ITR, have been provided to individual taxpayers. The ITR form now contains pre-filled details of certain income such as salary income. Next is document identification number, DIN. In order to bring efficiency and transparency in the functioning of the income tax department, every communication of the department, whether it is related to assessment, appeals, investigation, penalty, and rectification, among other things, issued from 1st October 2019 onwards are mandatorily having a computer-generated unique documentation number, that is DIN. Further, encouraging digital transaction. In order to facilitate the digitalization of the economy and reduce unaccounted transactions, various measures have been taken to reform the tax system. Further, the incentive for new manufacturing domestic company. In order to attract investment in manufacturing sector, The Taxation Laws Amendment Ordinance 2019 has drastically reduced the tax rate to 15% for new manufacturing domestic companies if such company does not avail any specified exemption or incentive. Next, abolition of dividend distribution tax (DDT). In order to increase the attractiveness of Indian equity market and to provide relief to a large class of investors, the Finance Act 2020 removed the dividend distribution tax under which the companies are not required to pay DDT with effect from 1st April 2020. Now we will move on to FRBM Act, the Fiscal Responsibility and Budget Management Act, that is FRBM. The bill was introduced in the Parliament of India in the year 2000. Subsequently, the FRBM Act was passed in the year 2003. It is an act of the Parliament that set target for the Government of India to establish financial discipline, improve the management of public funds, and reduce its fiscal deficit. The primary objective was the elimination of revenue deficit and bringing down the fiscal deficit. The other objectives are introduction of a transparent system of fiscal management, ensuring equitable distribution of debt over the years, ensuring fiscal stability in the long run. As per FRBM Act, the following must be placed along with the budget document annually in the Parliament: macroeconomic framework statement, medium-term fiscal policy statement, and fiscal policy strategy statement. As per FRBM Act, the four fiscal indicators, that is revenue deficit as a percentage of GDP, fiscal deficit as a percentage of GDP, tax revenue as a percentage of GDP, and total outstanding liabilities as a percentage of GDP to be projected in the medium-term fiscal policy statement. Now, if you look at the FRBM Act, government want to control fiscal deficit, and over and again, the time, if you look at, there are target we have fixed, but unfortunately, because of the pandemic situation, we could not achieve. If you look at the limit of fiscal deficit, we have fixed at 3% of the GDP by March 31st, 2021. But we are not able to do that. There is a limitation, as we all know that. And again, government is required to limit debt of central government to 40% of the GDP by the year end 24-25. But again, these are all with respect to the practical situation and the management of the funds, because we are encountering a number of issues with respect to fiscal management. Last 2-3 years, it was hectic for every government, especially not only in India, but our fiscal policy front, we are trying our best to reduce the fiscal deficit in the coming years. These are my references. Thank you.